Good morning, good afternoon, ladies and gentlemen. Welcome to one of our keynote sessions today. I'm very excited about this session. I'll get started very quickly. The focus of the session is incredibly topical. It's entitled, As Banks Transform into Digital Powerhouses, How do Startups and Fintechs effectively engage? And we have joining us Dominic Venturo, Senior Executive Vice President and Chief Digital Officer at US Bank, and Ysbrant Marcelis, Development Partner at Commercial Ventures. Guys, if I can encourage you to ask questions, the guys are very open to Q&A, so look forward to getting plenty of questions from you. But for now, I'll leave it to you two. Dom, Ice, the floor is yours.
Yeah, sure. Thanks, Lawrence, and thanks everybody for joining us this morning. I appreciate it. Hey, just a couple quick things. You may not be familiar with me or us, so I lead digital at US Bank. US Bank is focused on the consumer, small business, corporate, wealth, and trust businesses predominantly. And when you think about and payments, and when you think about the space that we're in and how digital intersects, we are focused on the product, services, and capabilities that we enable our customers to be able to do business with us. That's what digital does in partnership with our businesses. But importantly and relevant for this group, we also have the innovation group in digital, which includes what we call our Fintech practice, the engagements with the startup community, the accelerators, and the venture capital community. And so excited to be here this morning, have the opportunity to chat with you. Ice?
Likewise, very, very excited to be here. Very much appreciate the introduction and the opportunity to participate. We're a San Francisco-based early-stage venture capital firm. We're very focused on investing in infrastructure and platforms for retail, payments, banking, and insurance. So as the name Commercial Ventures suggests, that's really where we spend all of our time. Our portfolio includes close to 80 investments so far, including companies like Marqeta, Bill.com, Forder, MX, Socure. And one of the reasons I'm especially excited about today's conversation is because our firm's focus on fintech infrastructure. We find that a lot of our portfolio companies and more broadly companies we look at partner with, sell into, or get acquired by large existing incumbent players across financial services. And our partnerships with a lot of these incumbents have really highlighted some of the best practices, but also some of the lessons learned for, how do you think about working effectively, both if you're a fintech looking to work with large players, but then also if you're a bank, looking to work with fintech.
Yeah, thanks, Ice. And, when you think about that space and roles in the business, I thought it might be good. We'll share a little bit of sort of how we came to be together in terms of some of the work that we do together. But I had the opportunity to meet you at a conference probably 4.5 years ago, I guess. And, as a banker and somebody, and at the time I was chief innovation officer for the bank, as a banker, I tried to spend a lot of time in the fintech space and at conferences, emerging technology conferences, the actual fintech and the investment side of things. And this happened to be an investment focused conference where we had the opportunity to meet and get to know each other. And, and then over time, we spend time learning about each other and the businesses that we're in. It wasn't really all about, how do we do business together as much as it was these relationships develop over time. Ice, I'd be curious in having the group hear your perspective.
Yeah, I mean, I think you captured it well. I think one, it was, a very serendipitous moment that I happened to sit next to you at a table at that specific industry event, which my good luck. But I think the other point that you raised, which I think is a really important one, is these relationships take time, and I think a lot of it's about getting to know one another, getting to know one another's organizations, and trying to figure out how can you be a good partner. And if I think about the relationship we've developed with your team over the last couple of years, and I would say the bank more broadly, I think one of the interesting things for us has also been learning how the bank operates across different parts of the business. And seeing where can where can we help, and I think more broadly where do we see opportunities for tech companies to help in accelerating or moving forward some of those priorities, again, irrespective of whether it's in our portfolio or not.
Yeah, I would agree. And look, I think for the group, when I mentioned going to conferences and the like, events like this and the networking, these things are the things that we have to do in order to understand and learn more about each other. And so part of what we're doing is always recruiting in terms of the companies that we're talking to, the potential business partners, the areas of interest, but also looking for folks who have come up with, just really interesting solutions to problems we may have in the back of our head that we haven't solved yet. And so, sort of that always on, always active engagement is a big part of learning, and a big part of improving. And just to sort of connect that to our fintech practice, when I think about the work that we do in the fintech practice in the bank, a lot of what we're doing there is getting feedback directly from the venture community, the startup community, and the fintechs about, what's working well with our processes. What do we need to do to help adapt? And then we try to work with them as well to coach them on, what is it like to do business with a company our size in a highly regulated industry, and then help coach them, if not mentor them, through, the business introductions, the vendor risk management process, and the like. And ICE, I think, the way Commerce Ventures approaches the relationship side of things might be good for the group to understand sort of how you play that role with the companies you work with.
Yeah, it's a very good question. Maybe just to step back for a minute, because I think there's two components to this. I think there's the component in terms of, tech, and I think there's a component in terms of the bank. A lot of how we think about investing is very thematically driven. Not all firms are like this, but this is very much a core part of how we think about the world. So in many cases, we start with a theme. It could be digital currencies, just to pick one. And when we look at that theme, when you think about the process of kind of prosecuting that theme to an end conclusion, ultimately for us, it's one, is the theme or the category interesting from an investing perspective? And two, is there a specific company that we think is attractive from just an investment point of view or to deploy capital into? And when you think about that process, kind of end to end, there's a very important first piece to that process, which is to really understand what's happening in the market today. And there are two data inputs to that part of the process. The first is obviously speaking with a lot of startups to figure out what are they doing. But the second really important input is actually speaking with, again, given our focus largely on infrastructure, is speaking with a lot of existing large incumbents, banks, other financial services entities, et cetera, to understand what is the actual level of demand in the market around that specific category, that specific set of capabilities, and how are they thinking about that problem statement. And as we go through that analysis, obviously we come up with a point of view, and what we often find is that that set of input to develop that point of view is extremely important. At the end of that analysis, sometimes we find ourselves making an investment. In the cases where we make an investment, obviously cycling back and connecting the dots back into the corporate input piece and making sure that we can push value, drive value back into the portfolio is an important component. But I'd say the other important piece to this is where we don't make investments. And there are several good examples of where, we spent a lot of time looking at a category. Buy now, pay later is a good example of this, where we thought the category was super compelling, but we did not make an investment. But that obviously did not inhibit us from still trying to figure out, well, how do you make that connection happen, right? If you go through that process, identify companies that have an interesting model, either from a capability perspective or a distribution perspective, how do you connect the dots back to, existing large players in the market and figure out how do you drive value by connecting those two sets of players together? And I think that's a lot of how we think about the overall process is, start with that theme, but at the end of the day, whether we make an investment or not, how do you drive value back into some of those corporate partnerships we have?
I think that's a really good overview, Ice. And, just to sort of connect that when we think about our fintech practice, when we think about the work that we're doing within innovation and digital, we look at what we think is happening in the market and the trends, and we begin to identify what we think emerging trends or themes are, right? Is it a bit of emerging technology like, blockchain distributed ledger technology? Is it AI machine learning? Is it, so is it technology trend based, or is it behavior trend, right? The emergence of digital, the emergence of, always on, always connected, do it yourself, sort of autonomous banking behavioral shifts. And then, we look at both the companies that are in those spaces, but also the companies that are investing in those spaces. So their investment thesis may be, we think that this emerging technology has real promise in these spaces for lending, banking, financial services, and the like. And overall, in terms of the way that we then approach the market, if you will, it's through this direct engagement and the work that we do to help evaluate and move forward. And you have to be structured for that. So we have, like I said, a fintech practice. And I think it's important, if there are bankers in the audience, it's important to understand that in order to do this well, and we've been at it for a while, you have to have folks who are dedicated to the process, who understand the market, who understand the players, and then importantly are able to help facilitate the process so that your potential partners have a good experience and want to do business with you and see you as an ally and an opportunity, as opposed to potentially an account that's fraught with friction. So I think those are a couple other things in the space that we've learned over the years that have turned out to be important parts of the puzzle.
Yeah, I could not agree more. I think, maybe not to get overly provocative on it, but I think, innovation, particularly in kind of the corporate context, I personally believe is one of these kind of grossly overused and misused words. And I think we have seen a lot of players engage in this concept of kind of venture tourism, where the activity ends up being, totally disconnected from delivering real business value, or candidly, even the ability to internalize disruptive trends in a way that enables a practical response for the organization. So I think meeting with, investing in, or doing POCs with startups provides a hugely important utility, but you have to be able to apply any insights or any lessons learned to the core scale of the business in order to see any actual impact. And if I just kind of step back from that, if you think about neobanks today versus 10 years ago, and we just did this analysis, they're launching, let's say 5 to 6 times faster than they were, a decade ago. With some startups that we're seeing just in our portfolio going from, in initial vendor discussions to tech implementation in less than 3 months. And at the same time, most large banks are still bound by the same, 18-month planning cycles as they were a decade ago. So I think internalizing innovation is as much about changing the way you operate as it is about leveraging the latest tech, maybe even more so. And I think that sounds obvious, but I think to your point, I think very few organizations have actually adapted their internal processes. When you think about compliance, when you think about InfoSec, when you think about procurement, in a way where you can deliver at the same pace, while also recognizing that you're doing that in obviously a highly regulated environment with a much higher burden than many of these startups do.
I think, those are excellent points, and my 2 cents, and then we'll invite Lawrence in for the Q&A piece because I want to make sure we have time for that. But I think, when you think about redesigning your processes, you have to think about the elements you mentioned, but also your overall delivery model and the way that you're actually going to build, the way that you're going to pilot, the way that you're going to test. Do you even have a sandbox, the ability to test something? Do you have a developer portal and APIs, right? And so over the years, we've been building these capabilities out, and they're important enablers for that, so that you can do things like go from whiteboard to business problem and solution to an MVP pilot that you've got in a customer's hands in 8, 9, 10 weeks. And that's what the startups are doing. That's what the fintechs are doing. That's what people are doing that are built on top of, other software service providers, payments as a service providers, and the like. And they're able to, largely buy a lot of those services that are prepackaged and then customize them. And that is the state of play in the market. And so you have to be able to compete in the state of play in the market, or you're not actually competing. So I think, really good points. I appreciate it. It was a good discussion. Lawrence, let's bring folks in for Q&A if we can.
Yes, so some fascinating points made already. One of the questions asked is what are some of the common misconceptions of startups collaborating with larger banks? What are the pitfalls that startups need to avoid?
Well, I'll take one bit of that. I think one of the common misconceptions is that banks are maybe not able to adapt to and work with startups, part one, or part two, not interested. A lot of times it's hard to get to the right folks. So if you have a corporate venture group or you have a fintech practice or something like that at the bank, that's a really good place to start if you're trying to get in there. And I get that it's hard to get the attention of folks, but often it's not the case that the banks or the large banks aren't interested. It's that it's tough to get to the right people to be able to move it forward.
Yeah, I totally agree. But I also think that the point Dominic made earlier is a really important point, which is this idea that getting to implementation is a cross-functional process. I think a lot of times what we see is companies that I don't necessarily know if they underestimate it, but they're not used to dealing with the level of, again, compliance, infosec, other potential hurdles caused by existing tech that they have to, confront and process through to get to that endpoint. So if you're a startup that's used to iterating extremely fast, and you're dealing with a process architecture in a large bank that de facto takes 12 months to just go through its own internal checks, there's a bit of a cultural dissonance there that you have to be able to kind of get past.
Yeah. And then very often we see early stage companies will start out not thinking of the banks as their potential partners, and so they weren't designed for it. And then as they see the platforms and the opportunities, they start to design for it. And one of the first things they do is start to hire former bankers from a technology risk, information security, vendor risk management perspective, because there's a lot of complexity there that's tough to learn on the fly. But that is something we've seen happen more than once.
Yeah, I totally agree. Maybe one practical point to add to that. I think the other thing I think we've seen is, to take an optimistic estimate of how long it will take and multiply that by 2, and then take that as part of your own internal budgeting and burn estimates, because it's going to take longer. And I think, part of the risk is you're just going to burn through more money waiting for some of these contracts to go live.
Yeah, that's good advice. Lawrence, what else?
So we've seen a cultural shift during the pandemic. Banks are operating less like banks and more like tech companies. What does that mean for startups and fintechs who want to engage with these larger firms?
I mean, I think what you've seen is the environment change. I think you've seen customer demand change. I think we've seen, banks accelerating like ours, accelerating the work that we were already doing and already on the path to do in order to meet the customers where they are, right? So that's part of it. And yeah, it's more like the fintech space because we're doing rapid cycle delivery, we're doing rapid iterations, we're doing co-creation and test and learn, but the banks were already on that path. So as part of that sped up. I think the piece there is you have to decide the space you're in. Are you trying to compete? Are you trying to enable? Do you want to be a platform provider? Do you want to be a service provider? Do you want to be an enterprise software provider, right? In those spaces. So what's the role? What's the value prop? And to be able to articulate that crisply and understand sort of how that meets the customer needs are the really big pieces.
I totally agree. I think the other thing we've seen that I suspect is part of what's driving this is a pretty dramatic acceleration. In some ways, I think we're still at the front end of it, of non-bank entities looking to provide financial products, right? And there's a lot of discussion around neobanks, et cetera. But outside of that, I'm also talking about, telco, utilities, retailers, big tech, the Apples of the world that are going into this space. And I think there is a recognition by those players in large that they don't want to become regulated financial entities. So there is this fundamental question, I think, for most banks. Now, there is a difference between if you're, a top 20 institution like US Bank versus, a smaller institution. But I think the fundamental question remains, which is if that's the way that the world or the market is changing, the business model for banking also needs to change. And it's much more about how do you embed your product into that application or that ecosystem versus owning the product and the end customer relationship yourself. And in that world, I think technology becomes absolutely imperative to be able to, actually realize or deliver on that.
Yeah, really good point. Lawrence, I don't know how much time we have, if there's more
Yeah,
questions or if
we're running slightly over, but I just want to ask this final question because I think it's a really interesting question. VC investment is booming right now. We're all aware of that. What are the tailwinds behind this, and what does the forecast look like moving forward?
It's a great question. So I think there's kind of two pieces to this. I think the first piece is VC investing generally, and I think the second piece is VC investing in fintech specifically. I think one of the reasons we're seeing kind of VC investing booming is because the amount of capital going into into actual venture firms is also at an all-time high. I think partially that's driven by the capital markets environment, that there's large investors looking for attractive yield in an environment where you have zero interest rates, and there's other kind of macro variables that are impacting that. And I think part of it is that even if you look at kind of average deal size in the market, especially for late stage deals, which has dramatically appreciated even in the last kind of 24 months, a lot of this is just driven by large private companies staying private longer, and investors continuing to pile money into those companies. What's interesting is if you think about fintech, that trend is in some ways even more pronounced, where we're seeing both on the investment side but also on the liquidity side, even the first kind of 5 months of this year approach kind of 10-year highs in terms of investment, but again also exit activity. And I think part of what's driving that is a lot of the conversation we've been having this morning, which is 4 large existing incumbents that are in aggregate spending tens of billions of dollars a year on technology. For those incumbents to evolve, to thrive, to continue to gain share, they need to aggressively invest in technology. And a large part of what we've seen, again, even just in the last 12 to 18 months, and you've seen it with some of the IPO activity, is a lot of these enabler fintech companies reach very, very high valuations in both public and private markets as a function of kind of a recognition that that the whole market needs to continue to invest in this type of technology in order to transform.
Dominic, anything to add from your side?
Well, I mean, Ice is the expert in that space, so I'll let his question answer it, or he'll let his answer leave it there, but appreciate it very much.
All right, well, thank you so much, gentlemen. I know how busy you both are. It's been fantastic hearing your insights, and thank you. Have a good day. Really
yeah, thanks very much. Thanks, everybody.
Thank you.
Bye.
Thanks, everyone. Bye.